If you rushed to sell investments before Canada's capital gains inclusion rate jumped from 50% to 66.67% on June 25, 2024, you may have paid thousands in tax years earlier than you needed to. Worse, you probably never heard about the one-time election that lets you shelter up to $250,000 of future gains, at the old rate anyway. 6 mistakes turned a defensive move into an expensive one, and the last one is the trap almost everyone fell into. I read the fine print so you don't have to. Here's the number that changes everything. Each individual can designate up to $250,000 of future capital gains to stay at the old 50% inclusion rate, even after the hike, according to Department of Finance Canada in 2024. That means the panic selling most people did was often completely unnecessary. The room was still there, waiting. The first mistake was the big one, selling everything in April through June of 2024 just to lock in the 50% inclusion rate before the change. It felt responsible because you genuinely were beating the higher rate on those specific gains. But you were solving a problem you didn't have. The tax was never going to hit unrealized gains you simply held on to. Here's what that panic cost. A Toronto marketing director earning $180,000 sold $300,000 of her portfolio, crystallizing $120,000 in gains. At her 43% combined marginal rate, that was about $28,800 of tax. But had she waited and used designation at a retirement rate closer to 30%, it would have been about $18,000, per CRA and Ontario Ministry of Finance figures. That's roughly $7,800 wasted on one move. The fix: hold the position and use your designated gains room in a lower income year. The second mistake was believing a myth, that if you didn't sell before June 25th, all your existing gains would suddenly get taxed at the higher rate. That fear is what fueled the whole panic. But the higher inclusion rate only applies to gains you actually realize on or after that date. There is no retroactive tax on gains you simply keep holding. The cost of this myth is measured in what you gave up for nothing. Unrealized gains carry zero tax, and there was never a retroactive increase on past realized gains, according to Department of Finance Canada. So selling on this fear didn't protect you. It just brought tax forward and burned planning flexibility you could have used later. The fix is simple. Only gains realized on or after June 25th are touched, so leave your long-term holdings alone. The third mistake was never even knowing the designated gains election existed. Budget 2024 created a voluntary system that lets each person keep the old 50% inclusion rate on up to $250,000 of future gains. It was buried in the budget notes, so most people made irreversible decisions before they ever found out the room was available to them. Skipping this election is expensive. On a $250,000 gain, the new 66.67% rate adds $166,170 to taxable income versus $125,000 under the old rate, about $13,153 more tax at a 33% bracket, per CRA and Ontario figures. And by selling early, many people reset their adjusted cost base higher, shrinking the designation room they could have applied to even bigger gains later. The fix: map your largest future gains and reserve that $250,000 shelter for the ones that matter most. The fourth mistake was banking gains while ignoring losses. Investors rushed to crystallize winners but left their losing positions completely untouched. Capital losses can only offset capital gains. So if you don't harvest them in a year with big gains, you're leaving a valuable deduction sitting idle while your tax bill stays fully loaded. Here's what the idle losses cost. Danielle held $40,000 of losers with a $15,000 unrealized loss she never harvested. Selling them would have dropped her taxable gain from $60,000 to $45,000. 19 nursed $350 of tax instead of $25,800, a saving of about $6,850 per CRA. Remember, net capital losses carry back 3 years or forward forever. The fix: harvest losses in the same year you realize big gains, and check your carry forward balance in CRA My Account. The fifth mistake happens at filing time. Defensive selling often meant dumping complex portfolios in a hurry, and CRA requires every disposition reported on Schedule 3 with the date, proceeds, adjusted cost base, and outlays. In the scramble, people misclassified securities, mistracked their cost base, or double-counted proceeds, and every one of those errors quietly inflates your reported gain. Reporting errors turn a bad sale into a worse one. Sloppy cost-based tracking overstates your net gain so you pay tax on money you never actually made, per CRA's Schedule 3 guidance. In one scenario, waiting, using designation, and harvesting $50,000 of losses cut the tax on a $200,000 gain from about $33,000 to $16,500. A $16,500 swing on a single decision. Before I get to the last mistake, the one almost everyone quietly triggered, the fix here is to reconcile every disposition against your brokerage records before filing. If this is useful, subscribe. The next breakdown is already coming. The sixth mistake is the trap almost no one saw coming, the alternative minimum tax. When you bunch a huge one-time gain into a single year, on top of the AMT regime that was tightened in budgets 2023 and 2024, you can trip into AMT entirely by accident. It's the least obvious mistake because your software only flags it after the damage is already done. Here's why this one stings the most. With income near $300,000 from her salary plus gains, Danielle's return showed about $3,000 of extra AMT for 2024, which she can only recover in future years if her regular tax exceeds AMT, per Department of Finance Canada. They projected roughly 20,000 high-income individuals a year could get caught, essentially handing Ottawa an interest-free loan. Stacked with everything else, 1 year of panic cost her around $1,750, and over a decade the pattern could reach $60,000 to $80,000. The fix: spread large sales across years and run an AMT check before you sell. Log into CR8 My Account, pull your 2024 Notice of Assessment, and check Schedule 3 and any AMT carry forward before you make another move. That one review can protect your remaining designated gains room. Next, I'm covering the RRSP versus TFSA withdrawal order that quietly cost retirees tens of thousands. If you want to catch that, subscribe so you don't miss it.